Thank you, gentlemen, both for joining me. So I guess I'll give a brief introduction to the distinguished panelists. So to my left here is Greg O'Brien. Greg is the CEO of Shelf Drilling, which is a Dubai-based offshore drilling contractor. 33 rigs, I believe. And relevant for this particular discussion, they also have a large U.S. bond and a Nordic bond as well. So a very seasoned issuer. They have a stock listing in Oslo as well. So I think a great member to provide a perspective on this particular topic. And then at the other side of the chairs here is Nassim Haider. So Nassim is CFO of Al Jahaz Energy. Al Jahaz is a Saudi conglomerate, and they own, among other things, Lamprell, the big shipyard here in the UAE. They're a shareholder together with Aramco, Hyundai, and IMI Shipyard in Saudi, and they recently acquired a large subsea construction vessel. So they've been exploring alternatives in the direct lending market. So thank you both for joining.
Thank you.
Okay, so Greg, I think I'll start out with you because you've been in this alternative financing market longest. So Shelf has these two big bonds, and that's pretty much the debt in the company, right? That's a lot of the financing. So why don't you tell us about that and kind of how you ended up there and how that works for you?
Yeah, sure. So we've almost exclusively financed the balance sheet with high yield bonds since we started in 2012. I think Turner's presentation was spot on. There are a lot of parallels between offshore drilling businesses and shipping companies. It's capital intensive. The sectors are cyclical, often volatile. And I think that the word that I think of when I think about bond structures for a business like ours is flexible. One is the size and the availability of that market. The bank market has really shrunk for the offshore drilling space over the last decade. The bond market has continued to be pretty open and receptive. But the two main features are amortization profiles tend to be either non-existent or very limited. And also there are no financial covenants in bond structures. Our earnings can be somewhat volatile as cycles evolve and move. So we think it's beneficial not to have quarterly financial maintenance covenants. So we think it's been a good match for us. We've done, I think, 7 new issuances since 2018. So we think it's been a good product for the business.
Yeah, absolutely. And I guess the bond market is a market. And, in shipping and offshore, I think we're all quite used to cyclicality for good and for bad, but that provides opportunities, that volatility. But Shelf, tell us how you've played that volatility in the bond market.
The markets can open and close. We're a single B rated credit issuer, so the lower your rating, the more you need the right kind of appetite and backdrop to go to market. So timing can make a big difference. You mentioned that we have a large U.S. bond. We placed a $1.1 billion bond in Q4 of 2023. The jackup market was in a very good place. The credit markets were receptive. In hindsight, it was good timing. That was as much luck as planning. And then we were a first-time issuer in the Nordic market first half of 2024. I think I saw on the slide you said 6 to 10 weeks. We had never accessed that market. When we made the decision to go, we were in market in 2 weeks. So the Nordic market is pretty unique from that perspective. The documentation is quicker. It's not as intensive and as expensive as what you expect in the U.S. market. And last year was a record year. Part of the reason we decided to go is there had been a good window. It continued for longer than we had expected. So I think that is. It's helpful for us. There's now another market that's available to us between the Nordics and the U.S. That's a slightly different investor pool. So yeah, we're fortunate in hindsight. We're glad we went when we did. We would not want to be in market right now, given the volatility over the last week. But there do tend to be good windows if you have an ability to be patient with when you need to raise capital.
Yeah, so whether by luck or design, it was masterfully played, Greg. So Nassim, turning to you. Greg referenced, the time and sort of the process. You've been exploring some, let's call it alternative financing sources, looking at the direct lending market. Maybe talk a little bit about your experience in that versus banks.
Yeah, sure. Al Jahaz is a onshore construction company. So for us, we had a number of challenges accessing this market because it's the first time that we're going into offshore business. And for us, we also went through the process through an auction. So we acquired a vessel, and we had a very narrow window within which to finance it. So the options were either full equity, bank financing, or alternative financing. And what we've ended up in deciding is to go for the alternative financing for a number of reasons. One was the speed at which it was done. I think if we had gone for the normal traditional route, we would not have been able to complete the financing within the time frame that we had committed to. I think there are also a number of other benefits. You can get a bespoke financing deal when you're going with alternative financing. We had a number of constraints. For example, for us, we wanted to have an high LTV. So this is one of the points that you mentioned in your slide, that typically if you go to bank financing, you tend to get lower LTVs, 50, 60% range. And here we were looking at a higher percentage, mainly because for us, the vessel that we are acquiring is not so much in the marine business, but it's a tool to be able to enable us to win other work in our EPC work. So we didn't want to dedicate too much equity to this asset. We would prefer keeping the equity to our core activity. So what we were looking for was a high LTV. There are consequences to that as well. I mean, frankly speaking, you end up having a more costly loan. But I think the benefits of doing it this way, the timing, the high LTV, and the simplicity of the documentation really carried the day.
Just briefly, I think it's you are both Middle East issuers, right? Shelf is a Dubai-based company. Al Jahaz is ultimately based in Saudi. Maybe you could both touch on experience as a Middle East issuer. I think perhaps it's a little bit more specific to you, Naseem, but Greg, I'd love to hear your thoughts as well.
I think, in our case, the parent company is a Saudi company. So there is a certain learning process for everybody to understand that. You would think the banks in the Middle East would probably know us better, but the reality is that the flexible terms that are being offered by the Nordic financing are better for us in the end of the day. We ended up having to adapt a little bit the structure of the deal by having the borrower being a UAE company, but rather than being a Saudi company. But I think that it's a learning process for everybody. I think there are a lot of companies that are coming new to the Middle East, and I think Saudi itself also is opening up to foreign direct investment and making things easier. And I think this is probably a trend that's going to grow in the future, to have more companies from the Middle East and from Saudi Arabia look at this market.
Yeah, I could just add to that I think what we have seen as well. I mean, you saw the tremendous growth in the assets under management and private credit that's now at $1.6 trillion. Some of that money has actually come from the Gulf region. And so we've seen that certain of these funds have, let's say, made strategic decisions to lend to this region. So I would, they'd like to keep their investors happy as well. So it's very much an open market. So I think I was going to say, Greg, you all have engaged in some M&A the last couple of years. How does that work out with having your debt holders being public? How is it to have public debt?
I guess there are two aspects to the question. I personally don't see it as an issue at all to have public style debt. We're a listed business already. Yeah. So one of the obligations is from a reporting standpoint, quarterly financials, calls. We do that anyway. So there's really no incremental burden, if you will, from having traded debt instruments. The price does move around a lot. Our bond traded off 11 points on Friday. It really has no impact on us, right? Our bonds are in place until late 28 and early 29. It creates an opportunity for investors to look at those bonds in the market, but it really doesn't impact the business day to day. But I do think it is helpful from an M&A context. When you were already an issuer, it is easier to come to market again. We've done a tap at one point in the past where we had an existing bond in the U.S. And we came to market with a new issuance that was an add-on to our existing security. We completed an acquisition in 2022, and we signed the agreement without having the committed financing in place, which ideally you would have committed financing in place, but we were confident that we had sufficient time and there would be a market to place a new bond to support that acquisition. It was more just a question of price, and we ultimately did that. So I think having traded bond instruments does give you a way to access capital relatively quickly if you have an interesting acquisition that comes up.
Yeah, agreed. So Nassim, I mean, again, turning back to the process that you've been considering and looking at that huge growth in private credit, right? Maybe you could talk a little bit about the demand, right? I mean, in some ways, you're a new issuer in this kind of market, building new relationships, but how would you experience the demand, I guess, to work with Al Jahaz?
I think from our perspective, we trusted the process. Okay, so we went through a brokerage firm yourselves, and we went through a process, and we were pleasantly surprised by the feedback that we got from the market and the appetite the market had to lend to us. So I think that's something that we take comfort from, knowing that we will have to go back and dip into the market again when we continue our acquisition. So I think it gives us comfort that this is a process that works and that we would be comfortable going back and doing it again.
Very good. So again, I think it talked a lot about flexibility and about options through the session. And I guess, Greg, you've made a bet on the bond market. I mean, as you think about, you don't have too many maturities coming up soon. You actually have a very nice and long runway. But as you think of the long term, is it the bond market you continue to focus on, or what's the key focus?
I think so. I think we'll always be reliant on the bond market to some degree. I mean, as was talked about earlier, bonds tend to be slightly more expensive than options in the traditional bank market. You do have call protection. I think that was covered on one of your slides. So when you issue a new bond for the first couple of years, it is pretty painful and expensive if you wanted to repay or refinance. We have spent a little bit of time trying to look at the bank market here in the region. We're not probably seen as the same type of Middle East corporate as Nassim's company is. We've been headquartered in Dubai for 13 years. We really are a global business. We've had 25% of our operations in the Middle East. We work in India, Southeast Asia, West Africa, now Europe and the North Sea region. So we haven't been as effective as I would have hoped accessing capital here, but there is more and more capital in the region, whether it's the banks here in UAE or in Saudi. There is more of this kind of private credit market emerging in the region, and the equity markets have opened up here to some degree. So I think we will continue to be reliant on the international bond markets. They've been good to us, and I think we've been good by our bond investors. There have been a number of bankruptcies in our sector. We have not. We've been able to avoid an outcome like that. I'm confident we will continue to. I feel really good about the forward path for the business. But I think we always try to find different ways to access capital. One thing we have tried to do is be relatively simple in our capital structure. And I think it's hard to have too many different types of instruments. And so that's part of the reason we've continued to rely on the bond market, because it's kind of a tried and tested method that's worked well for us. And I think capital market investors tend to like simplicity in structures.
Okay, very good. I think we're going to conclude the session here, but I just want to thank Greg O'Brien, CEO of Shelf Drilling, and Nassim Haider, CFO of Al Jahaz Energy, and of course Marine Money, for taking the time today. And flexibility is good, so consider your options. Thank you. Yeah.